Charlie, thanks for that update. Do appreciate it. Well, it is today's big take. It's also one of the most read stories on the Bloomberg terminal. It's about the small band of quants who are shining a light into the shadowy world of unlisted assets. Yes, we are talking about private markets. Times have been tough, high borrowing costs, hurt returns. Managers are struggling to exit those investments. And then you got regulators circling. All that is bringing back an issue that has long haunted these opaque holdings. No one is quite sure how to actually measure their performance. Justina Lee is Bloomberg News Markets and Quants reporter. She joins us from our London bureau. Check out her story and more from Bloomberg The Big Take on the Bloomberg terminal and at bloomberg.com/big take. Justina, you profile some folks who are trying to demystify and shed some light on these returns in this opaque corner of finance. We're going to get to those individuals in just a minute, but why do they argue that this is something that needs to be uncovered? I mean, we're interested in it, of course, but why do they argue it needs to be uncovered?
I think part of the reason is that they're just here to try to answer, the most basic questions in investment management. Like, when you're paying fees for these managers, are they really doing better than the S&P 500? Or, how volatile are these investments really? And so they're really like very fundamental questions to this massive and growing asset class. But at the same time, I mean, it's always been really hard to answer these questions because when you have kind of a manager reporting, asset values, once a quarter or even less than that, and those values not being from a traded market, I mean, it gets really hard to even just answer those questions.
So, Justina, walk us through some of the people that you interviewed for this story, these quants who are at least trying to shine a light onto private market returns. And what they're doing, so worthy of writing a big take on?
Yeah, so the main quant I speak to is Barry Griffiths, who's kind of semi-retired right now, but his last job was as the head quant at, the private market giant Ares Management. And before that, he was at Landmark Partners, which was acquired by Ares. And what I think it's really interesting is that he's kind of a classic quant, but he didn't go into public markets where kind of a lot of people with these kind of backgrounds get into. And so his whole career in finance, he was at Goldman Sachs for a while, and then he was at Landmark, has been trying to kind of use math to find an edge in private markets. And what he told me is that he feels like, I mean, the math is a lot harder, but if you can crack it, you actually have more of an edge because in private markets, there are just not that many quants. Whereas we all know that the quants kind of run Wall Street at this point when it comes to, the stock market.
So how's he doing this? There's not much information that's available, even for investors who are investing in these companies or buying these products. How does he think he can actually measure these returns?
Yeah, so for instance, he's a big proponent of this method called direct alpha. And the math is actually not that difficult. But what it tries to address is in private markets, you have this issue where the manager gets to call capital and distribute it at different times. And so he tries to match the cash flows of your investment with the opportunity cost of what it would have earned in the public market. And to try to then kind of distill what exactly is the alpha you got from that private manager that you wouldn't have gotten kind of from public markets, which are kind of obviously low fee and very accessible. And so, I mean, I think you can kind of see how if that kind of analysis spreads, and it's important to note here, there's still a lot of, contention over how good these methods are. But if this spreads, I mean, you can kind of imagine, what's happened in the hedge fund world where, I mean, no one really gets to charge fees these days unless you can kind of prove that you deliver consistent alpha.
Yeah, talk a little bit more, Justina, about just how much this would change private markets. Because I know when we think about private markets, it's almost as if the returns are intentionally opaque.
Yeah, I mean, I think that's a really good point. It's the idea that you have to be a participant in this to actually
To know.
understand. Yeah.
Yeah.
Yeah, so like for instance, what kind of a lot of the practitioners say is that once you start using these methods, sometimes you see a manager who had great absolute returns, and sometimes maybe even it looks pretty good, kind of relative to the S&P. But once you drill down, then maybe you'll find out actually it's because they took a lot of risk, behind that, or kind of once you actually mash the cash flows, they didn't actually beat the S&P 500. And so I think that if this kind of spreads, you can kind of see how it raises the bar for a lot of managers the same way it's really raise the bar for stock pickers in the public markets.
So, do the folks who are participating in private markets, not the investors, but the actual folks who are selling these products and doing the investing, are they for more or less transparency in general? Like, how would you characterize their view?
Well, I think what a lot of them will say is that, there's nothing wrong with the status quo. I mean, partly that's because, private markets have had a really, really strong decade. I mean, at least on the surface of it, they've beaten kind of the S&P 500, and there are more companies staying private for longer, and so they always tell you that a lot of allocators are perfectly happy. And the other issue is that, because there's so much less data, I think it takes these quants a lot more effort to convince investors that these methods actually work. And there's still a lot of debate over how good they are. And so I think in that sense, I think a lot of people in the PE industry, I mean, they're not really thinking about these things just yet. But I think, as I wrote in my story, I think we're beginning to see some signs that a lot of allocators are more interested in these questions these days, especially with kind of interest rates coming up and kind of pressures piling on the industry in general.
Do we have any sense of just how many investors or like how many assets in total are using methods or working with people like Barry Griffiths right now?
Yeah, we don't have kind of any data to kind of really get into that just yet. But, a few examples in my story, the Japanese kind of GPIF, the massive pension fund. So they're using sort of their version of direct alpha. And what they said was that, we need kind of private markets managers to beat public returns. Like that's the whole point. And we kind of saw earlier this year that the Norway's massive sovereign wealth fund, I mean, they also use direct alpha to analyze whether they should get into private equity. And so, and kind of I talked about Arctos Partners, which is this other manager that says it's really changed kind of the way that they approach kind of evaluating PE managers. And so I think there are some signs here and there. And with kind of BlackRock buying Preqin this year, I think that was also a sign. They talked a lot about kind of bringing the data analytics of public markets to private markets.
Hey, Justina, thanks so much for joining us on this. Really do appreciate it. Check out her story. It is today's big take. Justina Lee, Bloomberg News Markets and Quants reporter. Check out her story at The Big Take on the Bloomberg Terminal. And of course, also at bloomberg.com/big take. Taking a look at equity markets.